Welcome to the SDA Housing Podcast, brought to you by NDIS Property Australia. Before starting this episode, we need to provide a general disclaimer. Information contained in this podcast is general in nature only. It does not take into account the objectives, financial situation, or needs of any particular person. You need to consider your financial situation and needs before making any decisions based on the information in this podcast. And you should consider seeking independent and professional advice for your personal circumstances. All right, let's begin.
Hello, everybody. My name is Min, and I'm your co-host with Ian, and you're listening to the SDA Housing Podcast. Australia explains, highlights, guides, and brings awareness about all things SDA in this ever-changing and dangerous world. Ian, Happy New Year.
Happy New Year, Min.
Thanks for coming in the office today. Today's topic is market sentiment for SDA, I guess. What are your thoughts, Ian? We've covered a few topics today. What are your thoughts on market sentiment on SDA this year?
Well, look, there's no lack of excited investors still coming into the market. It might be the kind of pent-up demand over the new year. However, there has been some changes in the last 6 or 7 weeks that have maybe altered the capacity of many of the lenders, many of the investors to get the lending from the main lender in this market.
So I assume that most people are unaware of these changes. Is that right, Ian?
Look, it would be true to say that the mum and dad investors probably are not aware because they wouldn't have necessarily been included in the email streams that are coming through. And there's some of the brokers that are still not quite all over what is changing. But the main brokers that we've been dealing with are very proactive and are taking steps to deal with the changes.
Okay, so let's talk more about that later on, I guess. For now, what other topics in our sector of SDA do you think should be made aware of to our listeners here of SDA environment?
Look, I think with the changing arena, we need to be more targeted. We need to be more focused on what that client is looking to get from their investment. And we need to be realistic about what they're going to achieve. And this is just part of being a good service provider. We should be taking that client and helping them qualify for this particular type of investment. And obviously we deal with multiple types of investments. So if this isn't right, there's always something else.
When you say we should be realistic, I assume we all, as in ourselves, stakeholders and also investors, how is the feedback from people when you give them a more realistic potential outcome for their investment? Is realism there on their behalf?
Look, oftentimes it's not my job to say to somebody, no, you can't do it. What we're doing is we're referring to the experts in this, which tends to be the brokers that are in this industry. And the brokers are coming back and saying, without this in place, you cannot proceed with getting a loan for this particular type of asset.
You're also talking about lending. I'm not talking about lending. I'm referring to SDA as a possibility for the potential investor itself. Realistic outcomes, realistic expectations, realistic investment returns. I mean, that's the conversation you have with a lot of investors, correct?
Absolutely, yeah.
And how are they handling the new way of being realistic with these returns in SDA these days?
Look, to be honest, there haven't been that much of a change in how we approach this. We've always been very conservative in our estimate of earnings. So therefore, the reality or the realistic approach to this is just very much in line with that. It's about contrasting between what we're offering and what they're seeing out there in the market from other players and telling them this is the reality. And this is the reason why when you look at our product and you see that you can earn 110, 120,000 rather than 180 to 200,000, why is there a difference? And it's because this is made up of multiple factors and variables, and we're coming in on the conservative level to under promise and over deliver.
Sure. So back to the word market sentiment. How do you feel the market sentiment is up until now, and where do you see it going for the rest of the year to 2025?
I think the market sentiment is obviously driven by a number of things that make it easier or harder for the investor and the different investor types to get into this type of investment. So when the lenders are becoming a little less generous, the market tends to quieten down, or people are looking at this and saying, well, how do I do it? How do I get into this? How can you help me? But I think generally the market sentiment is still good. People don't know what they don't know. And it's up to us to obviously take them through that process and determine whether, again, this is something that is going to work for them. So the market sentiment, I mean, I've been back from our holidays for over a week now, and I've been inundated with calls. So from existing buyers that were getting themselves prepared and new investors looking at this for the first time, there's a move towards more institutional investment, and that's coming in en masse. There's a lot of international interest in this. So watch this space. We'll see that come to fruition. But I would say in the year ahead, once they start to have a slowdown of properties being built and investors coming into this space again, you will see that those changes will be pulled back. It's just a case of making sure that we're doing the right thing from lender right through to provider.
Yeah, I totally agree. But I agree with 90% what we're saying. 90% with what you said.
Cover the 10%.
I wasn't probably what the least year. Yeah, you can read that data. But I'd say from a year ago to today, I think the interest for SDA has quietened down from a year ago. Okay, in terms of overall flowing around of stock for sale, promotion on Facebook, people talking about NDIS property, big SDA, our inflow of inquiries. I think it is quieter from a year ago and very much quieter from 2 years ago.
It could be a factor, though, of more sophisticated inquiries. In other words, they've got more information before they jump into this. They're not having to explain the concept of NDIS. It's not, brand new and fresh. It's something that they're going to add to an existing portfolio. And also there's a higher level requirement in terms of like their capacity. Yeah. So it changes who the buyer is and what their profile is. And therefore they're more cautious because they weren't in it 3 years ago. Yeah. So I would agree with that for sure. But I think for different reasons rather than it's just not an interesting topic anymore.
Off topic, moving on. I spoke to a client of mine, well, not a client of mine, an inquiry, SDA, who I met on LinkedIn 2 years ago. Did a podcast interview with him. He actually finished building his house back in August, September last year, and he contacted me a few days ago for sale. House is for sale, 4-bedroom HBS in the North Melbourne, and 3 tenants for HBS house, 3 tenants, one FA, one HBS, one IL for 180 grand rent. That's a very rare outcome there, having 3 tenants, yeah.
I don't know if it's rare.
Rare than over 3 in a house.
Well, if you go back a little bit, you will find that there are many, many, many examples of people that were fully occupied and they're at capacity. I had one of my clients come back to me and say, Ian, I don't know why everybody says you can't get full capacity. I keep on getting calls every week. But it depends on where it is. And it depends on the type of property as well. This is the thing that people miss, isn't it? You can't just build on a greenfield site, any old box. You've got to do something that really is tuned into what these participants want.
Hold that thought. The word greenfield. As part of the new lending criteria from the major lender, Origin, who lends out money to sub-lending mortgage managers, they came out with their criteria saying 20 or 35 kilometers max from a CBD of a major city. Yeah, if it's metro for sure. So the word greenfield doesn't correlate to 35 kilometers or below. They're all infield suburbs. So bear that in mind. If you're out there hunting for packages or blocks in the outer 35 kilometer radius from the CBD, it ain't going to get lending.
But then if you look at the non-metro and you're talking about being within a certain vicinity of the major hub where the facilities and amenities are, you might still get some greenfield sites. And there's some brilliant candidate towns that would be perfectly able to operate without having to have their big brother city, providing all the resources.
Now, on that very topic, 400,000 of the 680,000 participants in the NDIS are in metro cities.
Yes.
Okay? Now, to qualify for SDA and NDIS lending for property, for regional, you must be within 20 kilometers of the regional hub town.
Yeah.
So 20 kilometers of regional, 35 kilometers for metro. Okay. So before we go jumping into regional areas out there, everybody, calm down. Remember, the further you go away from metro cities, the smaller the base of numbers of participants are in the area, which means it's higher risk. So if there's turnover in participant tenants in the house in regional areas, it's harder to replace the tenancy.
And to counter that, yes, there's a lesser density of population, but what you'll also find is there's less people building and providing those SDA homes in the first place. So you've got a smaller provision in a smaller market, and it seems to find its own level. So absolutely, the focus for us has definitely been on what's happening in the metro. And that's one of the reasons why the trend generally in the last 9-10 months has been apartments and apartment living. And it offers a completely different outcome for the participant. And it's definitely something that is moving that trend is moving in much more predominantly over the next 12 to 24 months. And again, this is where the institutional investors are looking. They're looking at more of that metro apartment living rather than trying to build a 3 or 4 bedroom house in the middle of nowhere.
Sure. Now, back to the words in the middle of nowhere, with these lending changes being 35 kilometers and beyond from a metro city, these are possibly blacklisted suburbs. Ian, explain to our listeners what the word blacklisted postcodes means, please.
Well, it sounds really bad, but really what it is the lenders looking at their current exposure to the number of properties that they've lent for in a particular postcode. And they're saying, we don't want to continue our exposure in case there is delinquent loans or that there is an oversupply that doesn't look like being met in the next few years. So those blacklisted postcodes, this is a really good thing because we want the lender to have an oversight or an overview of what's being lent and what's being built in particular areas so that there isn't that oversupply. I look at it as very positive because it's another level of protection for investors, and it protects them against unscrupulous spruikers out there that are willing to go to the postcodes wherever they may land. And here's another thing. I was just speaking to one of our brokers and he said, there's one of the players out there that has been told this is a blacklisted postcode, but then they're finding all the next door postcodes and they're trying to actually put people into those areas despite the fact that there's an oversupply, and that oversupply is going to have an overlap with the neighboring postcodes as well. And the lenders, by reflex, are saying that we're not lending for those areas either. So it's not a case of this is a blacklisted postcode and everything else is fine. This is a benchmark of what we want to be looking at for the next 6 to 12 months. And then once we can see that those areas have a higher demand coming through, we'll lift that blacklisting.
Continuing on from what you said there, Ian, it's also bad news as well for those who are in those areas.
For sure.
Because, I'll give you an example, west of Melbourne. If there were 300, 400, 500 homes in west of Melbourne, outer, as in 40 kilometers out, and are possibly in the blacklisted or even close to the blacklisted suburbs, if you are a current homeowner of SDA in that area and it's blacklisted and it's empty, you're trying to sell out of your property, you can't sell out, Ian. You know why?
There's no lender.
It's blacklisted. So the incoming buyer can't get a loan to buy off the blacklisted suburb. So therefore, the original investor who's in that area is empty, is stuck, can't get out. In which case, they would have to sell it as a normal house at 700 grand, or 650, with a capital loss of 100 or so, or 200 grand. That's the outcome. And then the new incoming buyer must buy it as a normal house.
So this is something that, we have seen coming. We had taken precautions to not be selling into those areas, but those people that did get caught out, and even those genuine providers that have actually provided opportunities wouldn't have seen this coming. You don't necessarily have an oversight of what everybody else is doing in the market at the same time, but there are some red flags that should have been looked at. In those instances where those people are between that rock and a hard place, maybe they should consider doing an alternative type of accommodation. And that could be short-term, medium-term accommodation, or letting it out to non-SDA funded individuals that have disabilities. So there are some options.
So it's renting it as a still house to a still provider for $600 a weekend rent. Yeah,
absolutely. It would be better to hold on to it and see that market lift again than to lose that $100,000 or $200,000.
Because it buys them time to pay the mortgage partially while you wait for the oversupply, undersupply, lack of equilibrium rebalance itself up again. Yes,
absolutely. But then bearing in mind that there are going to be some of those suburbs where they were so oversold, we cannot see for the next 5 to 8 years that equilibrium being met.
Good point. I don't know if it's right or wrong, but it's a good point to raise. But I would say within 2-3 years, not 8 years. Yeah.
Well, we did a little bit of a data analysis through our analytics department. They said we don't see that demand coming back in the next 8 years. So I'm being optimistic saying 5 years, but I hope I'm wrong, because population grows and it will continue to grow in western suburbs. Who are we to say, it's not going to take up that slack? And it may well do. It's just that right now we're just using the numbers and projecting forward.
Yes, exactly. What else can we add to this topic today, Ian, before we finish off of market sentiment on our whiteboard here? What do you think?
Look, there's always an ebb and a flow. The way that this market works, we've seen it happen many, many times over the last few years. The lenders becomes a little bit tight and then it loosens up again. And it's all about managing the flow of funding and managing the flow of supply. And this is the thing that there's so many variables that we can't quite predict what's going to happen next, but we've seen this loosen again, and it will happen like it did last time. Maybe there's going to be a little bit more focus on the type of provision. I think the market as a whole is there's a breath, there's a intake of breath here, and let's see what happens. But again, follow the trends, look at that closer to the metro, look at where there's a population density, and this comes down to, apartment living. The houses, there's still definite room for those because not everybody wants to live in an apartment, but we've got to choose carefully. And now, as you know, we have to actually get a comfort letter and show that the client has done due diligence before they'll actually get the lending. And these are good things. These are things you can put into place before you make a mistake in purchasing the wrong suburb.
Yeah. Also, Ian, to counteract those challenges from the existing big lender we talk about, as time moves forward, the big four banks, as in CBA, Westpac, NAB, those big boys will start coming in with their own lending policies for SDA, NDIS, and then we'll see more of that flow in as well.
And there's a few of those that are on the periphery at the moment. Their criteria is a little bit harder to qualify for at the moment, but they are alternatives and they're precursors for the main lenders coming in.
Yes. I think that's about does it. I mean, we covered enough of freedom topics today, which we could spend a lot more time talking about in a future podcast, I guess, like the lending, like market sentiment, like data. Data is always changing in. And an example here is I want to throw you something on the board, on the table here in front of us. I'll just download some stats of the latest NDIS data. Email came out 2 days ago in mid-January here. If you're a listener and you want to know good areas that are sucked up, oversupplied or whatnot, I mean, this is a document, Ian, which is public information, Ian, which shows you, for example, let's choose one here. My first one is Ballarat. On my page here, Ballarat, Victoria, participants with SDA in use, 227. Participants had not yet using SDA, 44. Okay. And that 227 in use refers to group homes and legacy as well as new builds as well. So these numbers here, although may not be totally accurate and update, maybe 6 months old or whatnot, but it gives people some indication of public information to look at areas, numbers and stats briefly to tell whether these regional or metro areas are in high demand or high supply of participants, I guess.
We had this conversation with our analytics department yesterday. I had a client that is looking to buy a property in Hope Island. Mm-hmm. And her first response was, Hope Island has up to now been oversupplied in the apartment area. However, that is changing on a daily basis, and there's a possibility that demand that slack is taken up.
Yeah,
and who knows where that's going to go in the future? That could get worse or it could get better. So this data is essential, but there's still things we have to dig into on a local level, and that comes back from feedback from local providers.
Yeah, data, SDA data or analytics is good to a certain point. It's subject to accuracy, up-to-date numbers. It's also subject to factors out of the control of data, which is basically building product or designing product, which is above and beyond what is needed in terms of minimum compliance or usability for participants to enjoy. So, for example, back to Hope Island, your comment here, right? Yeah, probably is an oversupply of your apartments of SDA in the area. But if someone came along one day in a year, 2 years from now to build much more sophisticated and higher end, higher quality product of SDA apartments in Hope Island, Gold Coast, and that would make it a gem in that area. So
they would take people that were considering another suburb and they would come into Hope Island because of what's being provided there.
Yes.
And who wouldn't? I mean, if you've got the choice and it's only one suburb over, you're going to move.
Yeah. So my point is, just because it's oversupplied potentially doesn't mean it will always be, because there's always a bigger, better product coming along to override the old ones.
Well, what about the product that's already there that might not have reached that standard? That could be the reason why there's a lot that are standing empty.
Yes, exactly. Just like the normal, Ian, I mean, I'm sure we all want to live in a brand new house or apartment. If someone comes along next door and builds a nice brand new house next door, you want to jump out of yours and rent next door? Of course you will. Particularly for SDA participants who will get free rental accommodation here, it's free. They're not locked into staying there. They can move out next door next week.
Kennedy, and that question comes up on a regular basis. What's to stop these clients doing that? And look, the reality is nothing. However, the reality again is that it's the hassle of having to move. You're only going to do it if you see a significant advantage in making that move. And generally, if it's one that's next door, it's probably a lot easier than moving to a completely different suburb where you're not connected.
The key words here, Ian, to summarize this very point, is barrier to entry.
Yeah.
If you're in a lower socioeconomic region and it's cheap to buy land and cheap to build houses in the area, there'll always be more guys coming in after you to build bigger and better products or SDA, which makes it more attractive for them to leave. But if you're in a nice area like Hobart or Surfers Paradise, it's too hard to get into those areas. It's too expensive. Therefore,
you got to stay there.
Yeah. The supply ain't coming in to override your product of SDA. No.
Well, I heard, it was interesting. I heard somebody doing their marketing. They're saying if you're not paying for where you live and and it's being paid for by the government, of course you're going to up sticks and move to the best suburb. But the reality is, oftentimes these people don't feel as though they deserve that change. They've also got family, friends, network, carers, and support that's in the area that they live in, and they don't want to lose that connection by moving to a completely different suburb. So there are different variables that come down to being human, and that's the thing that we have to remember here. We're dealing with human beings and where they live.
Ian, thank you so much for coming in the office today to talk about this very topic on our podcast. Look forward to catching up with you the next few weeks to talk about another topic, maybe the lending changes as well. Yeah,
absolutely. Thank you, man.
Thank you very much. Bye-bye.
We hope you enjoyed this episode. Please make sure you are subscribed and following us so you can keep in the loop with all of our upcoming episodes. We would really appreciate it if you could leave us a 5-star rating, a written review, and to share this podcast with those that could benefit. Until next time, catch you on the next episode.